The S&P 500 has rallied furiously to within a hair of its all-time high, but hasn't gone too far too fast. The index is the most overbought since September 2020, and it's not just the Magnificent Seven that are fueling the rally. What does this mean for investors? Yahoo Finance reporter Jared Blikre is here to break it all down for us. Jared, what are you watching?
Thank you, Brooke. I'm taking a look at the S&P 500 going back to 2019. By the way, part of my job here is to find little things that might interrupt the larger trend and cause a reversal. And with all the bullishness in the market, I'm not seeing a lot of bearish red flags here. But one of the arguments is that the markets have gone so fast to the upside here, especially stocks and small caps, which we're going to get to in a second, that at least a pause is needed, or maybe even a reversal. And that's kind of what we're seeing here. These red shaded areas here, and you can see them, like there's one as well as a hard right edge. We're in one right now. This is when relative strength in the S&P 500 is over 70. This is a measure of overbought. And in fact, it's over 80 right now. And as you said, Brooke, this is the highest reading since we got in 2020. And that did result in a little bit of a turnover, of rollover in the market. But overall, I should stress that this is something that happens in the midst of longer-term bull rallies. So maybe a little bit of a pause expected here, but not the biggest deal in the world. Now, I want to shift gears a little bit to the S&P 500 versus its cousin, which is equal weighted. So the normal S&P 500 is weighted, heavier stocks like Apple, Amazon, those get a bigger weight in the index according to their market cap. But if you look at the equal weighted, which is really the S&P 493, not the Mag 7, it's a different story. So this purple line here is the S&P 500 weighted by market cap. And as you said, too, we are within a hair of the all-time high going back to the beginning of 2020. But in the equal weight, we have just punched above these highs that we saw in July. And a relatively interesting technical picture here, because this was a 52-week low. This is a 52-week high. And the time that we got there was 33 days. And if you go back to 1957, it has only happened more quickly one time, and that was in 1982. That kicked off an entirely new bull market that lasted throughout the 1980s. So this is just another long-term bullish signal that we're seeing here. I do want to talk about the Russell 2000 and small caps. This is the Russell 2000 in purple versus the S&P 500 equal weight, and you're going to see they are matched almost tick for tick here. You can see the Russell 2000, it might stretch a little bit higher, it might stretch a little bit lower, but they have been neck and neck this year, and that's really interesting because basically large caps have just performed as well as small caps, and the deciding factor has been the Magnificent Seven and how those are rated. Of course, we don't have those in the Russell 2000. Finally, I want to close with the Russell 2000 two-year chart and show how we are now just barely punching above a level that has caused resistance 1, 2, 3 times prior. Fourth time's a charm, we're going to have to see, but I like the technicals here, short and long term.
Yeah, Yahoo Finance reporter Jared Blikre. Jared, that chart that you put up on the S&P 500, that was really fascinating because if you kind of go back and look at the time correlation from where they actually, between the equal weight and then the actual valuation weighted, where they kind of unwound or detached, it was really about that time where NVIDIA held their earnings call and poured lighter fluid on this market for generative AI as well here.
You know, one final observation, I would say March is another divergence point this year, and that, of course, came with the internet bank panic, but you are absolutely right, Brad.
All right, Jared, thanks so much for breaking all that down for us. Appreciate it.